There's more upside ahead for tech. Let's bring in Brad Slingerlend from investment firm NZS Capital, also the former portfolio manager of the Janus Henderson Global Tech and Innovation Fund. Brad, so we're used to thinking of high rates being bad for growth tech, but is it necessarily a good thing for tech if the reason that hikes stop is that credit availability is drying up?
Yeah, well, you've got to look at it, obviously, with that sort of nuance to it. But we do think what the market is, putting the move aside today, what the market is adapting to is that we're much closer to the end of a rate hike cycle than the beginning of one, which means we're much closer to potential decrease in interest rates. And typically, irrespective of the circumstance that is happening, if you look at the valuations on growth equities, in particular the technology sector, the TMT sector, which was one of the worst performing sectors in the recent past, the starting point here is actually quite good in terms of valuation. So it's still pricing in a relatively high rate scenario, and it may come in under that. There are things that happen in what we're seeing with the credit cycle that are actually good for the large public incumbents. So if we see a less risk-taking environment, if we see less venture capital available, less venture debt available, less risk-taking behavior by employees who may have been thinking about leaving a big tech company to start their own business, they may not find the funding. It tends to favor the incumbents. And some of the things I think you're seeing in the market today demonstrate that the big companies are getting bigger and they may benefit from this turmoil that's happening in the credit markets.
Brad, I hear that. And certainly we were just talking with Mike Santoli about how some of the mega caps are even a bigger weighting in the major indices than there used to be. But so many of those, their valuations are also quite high. And I wonder, is there more potential upside to picking stocks that are a bit smaller, that perhaps are in a good position when it comes to data and this AI revolution that we're seeing take hold? Is winning in the AI revolution already priced into a stock like an NVIDIA or a Microsoft?
Well, it's certainly more priced in. And what we would argue is when there's this much disruption and churn happening like there is with AI, which we think is going to have far greater impacts to many industries, is you want to move your investing down the stack to the infrastructure layer of the economy. The infrastructure layer for AI is semiconductors. This is a group that, although it is up and recovered some off the lows, still doesn't reflect the full potential of this concept of AI pushing far deeper into all aspects of the economy. So there's many stocks that we're invested in there, whether it's Cadence Design, which is used to design the semiconductors themselves, ASM Lithography, Lam Research, the companies that make them themselves or that sell them, AMD, NVIDIA. We think there's a lot of opportunities in this infrastructure layer of AI that aren't perhaps as hyped as some of the name brand stocks that are out there.
How likely is it that some names that you currently think of as application providers in fact become more tool makers for AI? And I'm thinking about Adobe's announcement yesterday of Firefly AI. They're also planning to open up APIs for Firefly, which is potentially a whole new category for them if it works.
Yeah, so this is something I think when you see the power of a network effect or a business that has a large user base, whether it's Microsoft with their Office productivity tools or Adobe with their creator productivity tools, the ability to add on AI to actually enhance the network effect or the power of that business is something that I think we'll see repeatedly. And the flip side, you want to be very careful with a company that is late to adopt or faces some kind of innovator's dilemma where AI might just be too disruptive to their business. So they're slow or they don't fully adopt it, because then they end up losing the customers to some disruptive startup that is sort of an AI first mentality.
Okay, we'll keep an eye out. Brad Slingerlend, thank you.